Hello, hello, hello. Welcome, everybody listening through their podcast platform or YouTube. Excited to see you today. This is your host, Carson Herlean, talking today on the podcast Generational Gains, where typically it's my dad and I. We talk about business ownership, the life of an entrepreneur, real estate, and life insurance, and everything else in the money world we talk about, but from the perspective of somebody who's been in these industries for a very long time and somebody who's relatively new, just a few years in. And so we talk about our different successes. We talk about our perspectives on money and family and growing wealth. And so today I'm hosting, just talking through whole life insurance, talking through the benefits of locking in your cost basis, how you can get lucky with life insurance, and locking in your insurability. That's one of the most boring intros I've probably ever given to any topic of all time. Talking about insurability and cost basis of life insurance. Man, so boring, but I'm going to make it fun. I'm going to talk about a few different things that I think are going to change your mind of how you look at money and how you look at our lifetime and our lifestyle as well. So I'm excited to share with you a few things, and I actually really think this is going to be very powerful for most of you. So stick along. Please stay this whole time. I promise you it's not just boring life insurance talk. Let's get started here. And I want to start with two ways that we can get lucky with life insurance. And I think the mindset that is needed to really actually do this, when we break it down, the mindset's the most important thing. But what about the mindset are the two things? For me, it's curiosity, number one. And two, courage. You have to have those two things to get lucky with life insurance. Curiosity and courage. Doesn't make sense quite yet, right? Well, I'll start with curiosity because it seems like when everyone we meet has an opinion on money and finances and life insurance, and what those opinions are will vary from one another and vary from person to person. But I think what's most important is the time that people actually spend prioritizing learning about whole life insurance. Curiosity. Because when people think about life insurance, I think it's very easy to overlook all the benefits that come wrapped in this envelope of a life insurance policy. It's like for most people, life insurance is just about the death benefit and how much do I need and what's the cheapest way and easiest way to do it. And there really isn't enough curiosity to go beyond the death benefit. And because of that, I think people miss the big picture and the big perspective on everything that a whole life policy can provide. And so for a lot of reasons, I think people need to dive deeper and take action to really start to understand this. Generally, people's understanding of life insurance is often a misconception. As I like to say, most people think that they know about life insurance, and that's their misunderstanding in itself. That's their misconception. They think they understand what it is. And so to have enough curiosity to get lucky with life insurance, it really takes a person who has a daring spirit to continue to learn. Nelson Nash, the founder of this strategy who coined the name infinite banking, he calls it arrival syndrome. Most people just stop and never pick up a book after a certain age because they think they know everything, but their mindset doesn't continue to grow. And so getting started with life insurance, that curiosity is required if you're looking to do something like this. And, life insurance is a different asset class. It's a different type of asset. And when you look at different asset classes, you've got stocks, you've got bonds, you've got real estate, cash, equities, treasuries, CDs, and then you have life insurance. Life insurance is just another asset class on the books, but it works very differently than your typical type of investment. And that's why we say whole life insurance is not and will never be an investment. It's really a cash asset that is all designed using actuarial science. So you have this, the actuarial math that goes beyond developing these insurance products. And it gives us a little blink into the future about how much can be used and when it creates a product that really can't be replicated. And so what's really interesting is it's a very, very simple product when you get down to the terms of what you get out of this. But it requires a little bit of a different mindset. It requires curiosity to understand what you're actually buying and why. And not only why you're buying it, but why it works. You get a lot of this typical social media stuff out there. And it's really just this mistrust and this misconstrued cash value conversation and ROI conversation where it's like, hey, look, at the cash value, you get this and look how fast it grows and you can borrow against it. And it just bleeds dry the life insurance policy at the earliest possible time. And if you actually really understand what you have, that it's an asset that you can't just get anywhere, it's a very long-term approach to strategic capital management and accumulation. And this will create just much bigger and better and more secure and safer outcomes than what you could do with anything else on its own. And a lot of that has to do with the fact that you can use whole life insurance and create value inside of the policy through the policy loan options. So using the cash value or leveraging the cash value against your policy to use your money elsewhere. And you're doing more than one thing at the same time with your money. That's the biggest piece. You are letting money sit with the insurance company, earning interest and dividends, and then you're taking loans against your policy to then use your actual capital to go invest or pay things off or purchase something, the actual banking of the policy. And so you start to figure out that this is a policy that does more than just provide a permanent death benefit with a fixed premium. And there's more benefits than that, some people ask. Well, yes, but it requires a new way of thinking of how to get even more value out of life insurance policies. And the fact that the majority of people, including financial advisors, aren't aware of this, or if they are, they're not bringing it to their clients. It definitely is a requirement for people to be their own best advocate. And this comes back again to just being curious enough to understand. So why do people continue to buy life insurance, specifically whole life? For nearly 200 years, this product's been around. I've heard for a very long time that life insurance is outdated. That's what I hear all around. And it's boring and a poor investment with bad returns and all the bad things people can label it with. But here, it is actually working like clockwork for nearly 200 years. And really think people ought to ask, why is it still working? And I think what you would find is that it works because it's based off of math. 2 + 2 = 4, right? That makes sense. And when you have a whole life policy and you get down to the bare mechanics of it, and you understand that the cash value today must equal the future death benefit tomorrow and every day out until your age 121. What I mean by that is, if you look at an actual policy contract, at the very, very end, when it matures, when you are 121 years old, which is how long insurance companies project policies out till now, the death benefit always equals the cash value every single time. And that's just the math behind it. But what that means is that cash value that you have access to use is the death benefit. It's today's value of the death benefit, because the death benefit's smaller now and it will increase forever. And at the very end, death benefit has to equal cash value because the cash value is the death benefit. So in the beginning, if the cash value is a small amount and the death benefit's a big multiple, that's because you only have access to today's equity of today's death benefit value, which is what the cash value really is. The cash value is just the death benefit. And so because they have to be equal, the bigger the death benefit long term, the more cash value you'll have in your life. And so it's not like what people are accustomed to do, which is the investment idea. And they're thinking, oh, how can I get 10x my money over this time frame? And what kind of risk do I have to take to double X or 10x my money? But guess what? There's no risk. This is not an investment. This is a contract that is guaranteed to perform. No matter what, it's 2 + 2. It = 4 every time. The cash value is going to equal the death benefit in the end. And so there's only one type of contract that spells this type of policy out and guarantees that what you want to happen here. So no luck, no skill, no guesswork required, no hypothetical returns, no guessing with the market. But be curious enough to understand why this happens, how it happens, and when you do that, it'll all make sense. And so the insurance companies, they just put a number on a table in black and white, and you look at the net costs of the commissions, the fees, and the cost of the life insurance, and you look at the statement. Well, and you look at the illustration. Whereas what we're used to doing is getting a statement at the end of every quarter or every year from a 401k administrator or a financial advisor or money manager that gives us the typical annual return. So we're looking at the annual rate of return in those type of accounts versus the cost basis in life insurance. So we're not comparing these things apples to apples. And they're not the same product. One's an investment, one's not. So you can't compare life insurance as an investment because it's not going to be one. It's all guaranteed. There's no risk. That's why when you look at a 401k statement, good luck trying to find out what actually is going on. All you'll be told is what it earned last year, and it'll say what type of risk you're taking on. Is it moderate, considerate, or conservative or very risky. That's all you really know. Whereas life insurance, it's a ledger year to year that tells you exactly what's going to happen every single year on a guaranteed basis. Okay. And I guess things aren't always guaranteed because you could not pay premiums or something like that, but it's a night and day difference. And so if you really just look back to the idea of being curious, and you really have to care enough to be curious to look into what's really happening with life insurance, and then you got to get away from that investment type of mindset. Because when you look at this as an investment rather than a life insurance policy, it starts to skew some things. And it starts to skew because you want to pay a premium. Whereas when you're looking at this as a strategic source of capital, it's skewed because why would you want to pay a premium? Sorry, I should phrase it differently. Why would you want to pay a premium, some would ask? A premium's bad. You got home insurance, health insurance, car insurance. Premiums are an expense. I don't want another bill. Whereas when you look at this as a strategic source of capital, you cannot wait to put money and pay your premium. And you'll never want to stop paying premiums because we always are going to need a place to put extra money. We always need a place to store cash. This ultimately becomes a way for you to allocate capital across your entire life. You've got the sovereignty on your own end to decide how you want to deploy your capital and repay that over any time frame you choose. So eliminating the middleman, which is the traditional fractional reserve banks, Wall Street, that we're all conditioned to think has our best interest and that they're building wealth for us, it's not the case. So one, be curious. Two, be courageous. But further along, you get into into having your own policy. And eventually, the more you realize the power of every single premium that you pay into it and how that's working for you and how it's able to accumulate capital, that's something that really you completely have control over without needing a trusted banking third party that you ever have to ask permission to use the money for. And so really, you have to ask yourself two questions. How much can I get of this type of policy? And it's going to be really up to your available cash value, what you can access. And so when you go to the insurance company to try and get a loan from the insurance company, they don't, it's a loan against your own policy. They don't care what you're taking out. They're just going to ask, how much do you want? Where do I send it? That's it. It's that simple. Imagine going to a bank at Wells Fargo and saying you want a loan or you want to take money out of your bank. If you wanted to take 25 grand out of your bank, for example, they're not going to let you. You want to take 25 grand out in cash? They're not going to let you. It'll take days for them to put that together and help you do that. If you want to take a loan from them, it's on their terms. And the insurance company, when you take a loan from yourself, it's against yourself again. So they don't need a credit score. They don't need your income. They don't need to know what you do for work. It's a private contract between you and the private insurance company. And so it requires the courage for you to take action and go a little bit against the grain, especially if you're stuck on the same narrative that these policies are a scam or a fraud or some crap like that you might hear. And everybody has a brother, a friend, a boss, a spouse who's standing by, ready to tell you whatever investment you want to do sucks. In this scenario, let's call it whole life. And it's mind-boggling to see how the standard financial advice has really gone against life insurance. And it really doesn't make any sense to me. So what I'm saying, though, is be ready for that. Be steadfast in your belief that, hey, I'm building this rock-solid foundation asset that can never go down. It's gone up for 200 years with a better track record than anything in the world, basically. And it's got the liquidity that you need. And it's got the ability to leverage it, all backed by the insurance company and the underlying collaterals in place to guarantee it all. Somehow, a lot of people have been brainwashed into the idea that you have to take risk to get high or to take a high risk amount to get a high return. And the only thing that matters is a high return. We're brainwashed to think. And again, if you can create 3-5% returns with no risk, that's a 15% return. And that's the kind of thing you can do when you have access to the capital that you keep recycling over and over again. And getting the use of your money in more than just one place at a time, rather than putting your money in one place, trying to take on high risk to get a high return, you can take no risk and use it in multiple places and get the same or even better or better rate of return on your money, especially over the long run. But that takes courage. A lot of people will tell you you're crazy. So you need to put your adult pants on, get ready, and hit the ground running. And I think it's really important to understand that with life insurance and practicing infinite banking, and by doing infinite banking, you will have the ability to control your financial life and that lending and saving function of money in your life. And so to control the leverage in a superior way that you really can't duplicate by borrowing somebody else's money, by borrowing money from the bank or borrowing money on margin, because those examples carry risk that you don't have when you take a policy loan. Because think about it very simply. When you take a policy loan, what is the collateral? It's the cash value that you've already put into it. So the life insurance company does not care whether you take 2 months or 10 years, or maybe use the policy for retirement and never repay the loans. Now, we do educate people and give them caution to be responsible with their money, but you can repay your loans whenever you want. And so you need to be an honest banker with yourself if you're doing this. But the core of what I'm trying to say here is that you have the ability to leverage smarter and safer. And when you have a whole life insurance policy that you have issued on your life, it locks in your age. And from that date forward, your premium is guaranteed never to increase no matter what. So in investment terms, when you make an investment, the amount of capital that you put into it, that's your cost basis. When you start a whole life policy, there's only one type of permanent life insurance out there that actually locks in your cost basis for life. And they do that with whole life insurance by locking in your current age now. Even though those other types of insurance products that you can buy, called universal life insurance, term insurance, they're different flavors of this. There isn't one policy besides whole life insurance that locks in your age and guarantees your premiums will never increase the rest of your life, and that the death benefit will increase the rest of your life, guaranteed. That doesn't happen. Only this product. That's why we use it for banking. And so really, when I'm looking at this, I want to understand the importance of establishing a cost basis. And again, in layman's terms, it's just locking in your insurability. That's the awesome part. It's easy. It's like getting a mortgage. A lot of people really are interested in prepaying their mortgage or paying their mortgage off as fast as possible. Well, when you pay it off over 30 years with inflation, that payment gets less and less and less and really starts to work in your favor. And the same thing happens when you're making premium payments to your life insurance policy. Everything's guaranteed based on that premium so that it's never going to increase. And with whole life insurance, everything's baked into it. You're never going to have additional riders or additional premiums or additional costs. It's just the set premium. And so all the costs all the way through, everything's baked into it and on the ledger you look at right in the beginning. And I can't tell you or emphasize enough how many times I've talked to people who think they have a whole life insurance policy only to find out they don't. They were lied to by their insurance agent or their financial advisor, and it's a IUL, a UL, of equity policy, a term policy. It's not what they thought. They came looking for this, and they're utterly disappointed because they reached out to somebody they trusted. They've been putting money into something, hoping it would work out every single year. And it's not. That's not the way life insurance is supposed to work. And so you should read the fine print of your contract and know what the policy is before you set it up. But that's why we are so keen about who you work with and how you set it up. It needs to be done the right way with the right people to do banking. And it makes me realize how blessed people are when they choose to set up a whole life policy the first time or at a young age or a good amount of money, because they're setting up a strong foundation and they're providing certainty in their life. The only certainty you can get from life insurance is from whole life. And the idea that I had, and kind of going through this episode, kind of scripting out some ideas for this, was getting lucky with whole life. And it really came to the fruition from that experience and talking to people about the unfortunate experiences of coming to the realization that they had the wrong policy, they had the wrong product, they had the wrong savings plan all along. They were unlucky in a way, or so to speak, because they thought what they had done was this and it wasn't. And in most cases, I'm actually able to kind of rectify that and work on fix that, because you can do different 1035 exchanges and move cash value around into the different products. But getting lucky with whole life is really meaning that once it's in a place, it really can't ever be taken away from you because it's guaranteed to perform. You've got one responsibility as the policy holder. The only risk in the entire thing is on you. And the risk is funding it. You got to capitalize it. You got to build it up. If you can't fund it over the years, it's not going to be as beneficial, but that's the risk you're taking on. The risk is on you now instead of somebody else. The control is in your hands. So really, you don't need any luck. You need luck with everything else. You don't need luck with this. Maybe you would need luck if making sure you set it up right and making sure you have the right mindset to start this with and being curious. And maybe even curiousness is not enough. You need to dismiss other questions, other ideas people are sharing with you, because this is the truth. And so it requires more curiosity at this stage. But when you're willing to look deeper into it, or at that point, Now that you've done your homework, you're ready to take action and be different. Be like that successful person who has a whole life policy. And sometimes also, there are people that have whole life. Those people that have whole life sometimes didn't even realize they had it. They were lucky. So you need to get lucky in terms of being in the right mindset, in the right place at the right time to catch this idea and make it work for you. Nelson Nash, the founder of the infinite banking concept, said that the infinite banking concept is something you can catch more than you can learn. It's like you have to be in the right place at the right time with the right attitude to really get it done. And you need to be curious and brave enough to check out something new. So guys, basically it's all about just being lucky enough to catch the idea and then be smart enough to do something with it. Thank you for joining today. Now I leave this to you. It's time for you to take action. If you want that certainty, you want that guarantee, you want that foundation in your financial life, this is it. You know how to find me. Find me on social media, email me, call me. I'm here to help. If you would like to learn how to set up a policy of your own, you'd like to build a banking system you can trust and build the foundation on, please reach out to me. I would love to teach you the strategy of banking more in depth. Thank you again for listening. We'll see you on the next episode.